So this is the final part of our revision for capital investment appraisal. And this is the last type of question you would see. So apart from the two questions we went through before, this, if you see, this is also capital investment appraisal. So you'd be given the cost of the machine, and notice that you're given the number of years of life it has, and then the resale value at the end of the period. Then you are given the savings, which is how normally when we are calculating NPV would include the savings in it. And then also we are given cost of capital, which you also know is discount factor. Then you are given which is 20%. And here notice that you are given inflation as well, which is 5% value. And then you're also given, this time the twist is you're given tax as well, and then capital allowance. So these are new additions to what we've been studying already. So to answer this kind of question, you have to break it into two parts. You first have to, this is the format which we use. So you first have to put the year. So we have the year 0, 1, 2, 3, 4. Then the written down value. Then your capital allowance, taxable profit after capital allowance, and then your amount of tax. It looks quite complicated, but it's not really that bad. So you'd first start in year 0. The machine cost 60,000. So you'd put that in the first year. So that's 60,000. Now, how do you get these values that go on here? Always take note of your capital allowance. So you're given a capital allowance of 25%, and that basically means that you are not going to be taxed. Capital allowance is kind of like a shield from tax. So you will not pay tax on 25% of the capital which you used in purchasing your equipment. So if you look at the side here, I've made a few notes. So the capital allowance is 25%. So you would multiply the cost here by 25% for each year. So this will be 60,000 times 25% will give you 15,000. 15,000 times 25% will give you 11,250. 11,250 times 25% will give you 8,438, and so on. And what you need to notice is to get this value here, you have to subtract 25% from 100%. So here you'd be multiplying through by 75%. Don't know why my hands are shaking. So it will be 60,000 times 75%. That'll give you 45,000. 45,000 times 75%. So for example, if your capital allowance was 35, it will be 35 here, then it will be 65 there. So you just need to make sure, to make it easy, instead of adding and subtracting and multiplying, just multiply the capital allowance line by the value you're given, and then the difference between that and 100 you multiply for the first column. So now we've done that. And the taxable profit, so basically you are told that you would be saving 29,000. So usually this would be the savings part, you know, where we'd put the savings of the machines, and we'd normally in another question it will be the same value throughout, for example 70,000 throughout. But the twist here is that you're given 5% inflation, and inflation affects it in the sense that each year it will rise with inflation. So you'd start with your first value 29,000, Then when you go to the next year, you take into account the 5% inflation. So it will be 5% times the 29,000. And whatever value you get, you'd add it to 29,000, which will be 30,450. And then the same here. So each year, it increases by 5%. So for example, if you're given 10% inflation, it will be the same. So that would be your taxable profit because you're taking into account inflation. Now you'd move to the next step, which would be taxable profit after capital allowance. And that would be this, the taxable profit minus the capital allowance, because you're not going to pay tax on the capital allowance. So here it will be 29,000 minus 15,000, 3450 minus 11,250, and that will give you the taxable profit after you take out your capital allowance values on which you don't have to pay tax. Then your final step will be tax. So you're now going to take tax on the final values which you have here, and the tax is 35%. So it will be 14,000 times 35%, which is 0.35, and then so on and so forth. So that will give you these values here. So this is the first component: WDV, capital allowance, taxable profits after capital allowance, and your tax. That's your first part of the question before you go to the main part of solving for the MPVs. So now we move on to the second part of the question. And now if you notice, it will be our normal question will be machines, savings, discount factor, present value, MPV. But here, because you have the tax mentioned, you need to include it. So if you notice my notes here, these are the extra components you need to add. So you'd have the cost of the machine, then your savings, but then notice that your savings include the 5% inflation, then your NCF before tax, which will basically be the cost of the machine plus the cost of savings, and that will give you the final values of which you take away tax. But then notice in the question it says it costs 60,000, and at the end of its 4-year life, it's expected to have a resale value of 4,000. So in this case, in the 4th year, you're going to be selling it on for 4,000. So you would have to include it in the first part. So it will be minus 60,000 here because that's what you spent on the machine. And in the 4th year, it will be positive because if you sell the machine, that's the value you're going to get. So now we add all the values here. So this will remain the same, that will remain the same. Notice that in the 4th year, you have that 4,000 value here. So you need to add them, which will give you this figure. If you forget, that means your 4th column will be entirely wrong. So the 4,000 is the resale value. And then this is the savings, which you would add to it to get your NCF before tax. So these values here, this step is very important because to make sure you don't miss out on any extras in the question. Then after your NCF before tax, you take away your tax, which are the values which we calculated over here. But then also note in the question that she says the price increases start with the year 2 cash flow. So notice that we need to start to deduct the tax from year 2. So it will be minus 4,900, 6,720. So because we are starting from year 2 and it's for 4 years, you are going to end up having a value in year 5 because you started deducting tax from the 2nd year. So that gives you then the NCF after tax, and then your discount factor. So to get the present value, you'd multiply NCF after tax. So you've done all your tax deductions here. That gives you your present values. Then you add them all up, and then that gives you the NPV of the project, which will be 8945. So then that will give you the final NPV. So always remember these steps. Do this bit first, separate, and then this bit second, and then that should help you to be able to calculate the NPV, which is accurate. And then you would be asked, would you recommend that the company invests in the machine or not? So based on the NPV value, you're able to say if it's positive, then it should be invested in. If it's negative, then it shouldn't. So that is another type of question we could come across.